November 14th, 2024. Today was basically just a bear channel day. You can see yesterday is where the bear channel started. You're here on bar 54, and we've had a bear channel pretty much the entire past couple of days. Obviously, when you get a bear channel, what should it convert into, or what's the most likely scenario? Most likely scenario is it ends up converting into a trading range at some point. However, it doesn't necessarily mean that'll happen tomorrow. If the market continues to channel down, you should just assume it's going to continue to be a bear channel and trade it as such. Today, we had a bear surprise on the open with bars 2 and 3. And if you'll notice, we had a bear surprise on Tuesday and we had a bear surprise on Wednesday, both on the open as well. Not so much on Monday, a little bit, but not so much. But we had a bear surprise on Tuesday and Wednesday this week. So I thought it was notable that we might get a bear surprise on Thursday as well to start the day. Bar 1, a bull bar, but a big tail on the top, rallying to around the bar 81 close from yesterday. So the area where there were 4 straight bull closes. Most likely, we will get to that area and there'll be sellers. 2, a bear surprise. So a good surprise for the bears. We're probably going at least a little bit lower. How much lower? I'm not sure. It's a possible low or high of the day. So you could sell below 2, put a stop above 2, and just hold for a swing. Follow through on 3. So bars 2 and 3 got followed, or bars 2 and 3 consecutive bear bars closing near their lows. Most likely, we're going to get a second leg sideways to down, probably going to go at least a little bit lower. Bar 4, a bull bar closing near its high. This is a possible low of the day. I'm going to actually meant to throw it in my 1 and 3s. I think it's, 30% chance, maybe 35% chance that this is the low of the day. But it's really not all that great to be buying above 4 because most likely it's not the low of the day. So if you're going to buy above 4, you have to ask yourself, are you okay with losing that trade? Probably 70% of the time. And if you are, then great, it's a perfectly reasonable trade. But if not, it's probably better to wait. Disappointing follow through on 4, and that's why you get a big bear or a disappointing bar on 5. So basically just disappointing follow through bar on 5. So big doji bar. The bears see a low 1 short. The bulls are hoping that 4 is the start of their bull trend, and that 5 is just a disappointing or it's just a breakout pullback. 6 rallies back up to around the 4 close. So the bulls who bought the close of bar 4 disappointed in 5, using 6 to buy back their shorts. And that's what caused 6 to be a doji bar. 7, a big tail on the bottom. So you can see we went back to the close of 3. Traders who sold the close of 3, disappointed in 4 and 5, used the sell off on 7 to buy back their shorts around the bar 3 low. Probably sellers above 7 scaling in higher, but it's possible that we're towards the top of the trading range. Or sorry, towards the bottom of the trading range. 8, a big outside bar. So outside down for the bears. Good for the bears, but it went further above 7 than it went below 7. So really not as ideal. Probably more buyers below, scaling in lower. However, it's still a tight bear channel. And 2, 3, and the tail on 4 is the first leg down. So we're probably going to get at least 1 tick below the 4 low. 9, a bull bar. It's a higher low double bottom for the bulls. They're hoping that 9 is the low of the day and that we're going to rally. However, what's the problem with this? The problem is that 9 is giving you a second entry at a better price. So usually you are not going to get a second entry at a better price. If you get a second entry, it's normally going to be at a worse price. So 9 being at a better price than 4 is suspicious, and that's one of the reasons why you get disappointing follow through. The big outside down bar on 10. But are you going to sell the close of 10? Well, if you have a really wide stop, you probably can. But look here, we got a big sell climax and then a bounce, a sell climax and then a bounce. So another sell climax, what's probably going to happen? It's probably going to be a bounce. 10 is also a third leg down, 78, 3, and 10. So 1, pullback 2, pullback 3, still 3 legs down. So really not as good to sell the close of 10 because of how climactic it is. There's probably more traders buying back shorts in this area. However, it's still a tight channel down. So if you sell above 10 rather than selling below 10, you chose to sell above 10 with a measured move stop, you're most likely going to end up making money. 11, an inside bar, a wedge, probably sellers above, scaling and higher, but probably 2 legs sideways to up. Only reason I say probably sellers above is because 11 is not a very good buy signal bar, so there might be more sellers above there than buyers, but really not all that great. 12, a bull surprise. We're probably going at least a little bit higher, and you have to be expecting at least a second leg up from 11 and 12. An inside bar on 13, so it's a high 1 buy for the bulls. The doji bar, you have to expect we're probably going to get at least a second leg sideways to up. 14, a bull bar, small tail on the top. Again, probably sellers at the moving average. This is the first time we've touched the moving average so far today, so I'm not sure how much higher we're really going to go. 15 consecutive bull bars, 14 and 15, and we're probably going at least a little bit higher. It is a tight channel up from 11 to 15. However, it's a tight channel down. 75 to 10 is a pretty tight channel down. And that channel is, a bigger, more important pattern than this rally. So it's possible that this rally is just a pullback to around 50% of that tight channel down, which is what ended up happening. So some traders, this area, are actually selling the market, taking a chance that the rally is only to the midpoint of the tight channel. And if they're selling, they're taking a chance that the second leg down from this, it's a wedge, but the tight bear channel, they're taking a chance the second leg down gets down below this area. Most likely, I think maybe 60% chance that we get down here before we get up here. 16, disappointing follow-through bar and inside bar, another high one for the bulls, but probably still should get a second leg up. However, this looks like we're trying to form a high. 17, a bear bar closing near its low, probably buyers below scaling in lower. 18, a second bear bar. So how far down are we going? Take a guess as to the next support. See if you can figure it out. What is it? The open gap, right? The 11 high and the 13 low. So there's probably buyers at the 11 high if we manage to get there on this test down. Because this rally, so the reason it's not good over here and it's good over here is because this rally from 11 to 15 needs a second leg up. And it gets the second leg up here with 27. But 27, we get a pretty big failure up in this area, showing that bulls were not really all that interested in buying up here. They instead sold out of their longs. And so then we're starting to get strong bear bars closing near their lows. So it's really not all that great to be buying in this area. 18, another bear bar. So 16, 17, and 18, all bear closes. Probably going to get a second leg sideways to down. 19, another bear bar. You know that 17, 18, and 19 is going to require a second leg down, but also the rally to 15 is going to need a second leg down. So if you are long, this might be a minor reversal down. Some traders would scale in around 50%. 20, a bull bar. Probably, again, still looking, bulls who are buying here are just looking for a second leg, and they'll see what it ends up being. An inside bar 20, or not quite an inside bar, a bear doji bar 21, probably sellers not too far above, buyers not too far below. Probably some sort of minor reversal up, but that 16 through 19 is going to get a second leg as well. 22, another doji bar, so consecutive doji bars, 21, 22. Probably going a little bit higher, but not too sure. 23, a bull bar closing near its high. Again, the second leg, you're going to get a second leg from the sell-off to 19, and you're going to get a second leg from the rally to 15. So what do you do with that information? It means that if we go a little bit higher, expect sellers. If we go a little bit lower, expect buyers. If you're buying above 23, you're buying after consecutive doji bars, 21, 22. So expect probably at least a pullback. 24, a bear bar closing near its low, low one short. After a 5-bar bull micro channel, probably buyers below scaling and lower. 24, 25, consecutive bear bars closing near their low, but probably buyers below 25, scaling in lower. The bears need another bar. I don't think we're necessarily always in long. I think this is one of those days where the context was always in long a lot of times because the bulls should have gotten a reversal, but it was never too clearly always in long. So you could have argued we were always in short for pretty much the entire day. So 26, an outside up bar, good for the bulls, but it looks like 3 legs up, 20, 23, now 26, and then a disappointment and a failure on 27, and then you get a bear bar closing near its low. Double top bear flag, 19 neckline, so 16, 27, double top bear flag. At least a 40% chance that you get a measured move mat down, taking a short below 27. Your risk would be 5 points trying to make 17 or 18 points. So good for the bears. 28 consecutive bear bars closing near their lows. This is just sell to close. 27, 28 really strong. If you sold 27, what was perfect follow through? If you're thinking about this this is one way to think about swing trades. Instead of taking the swing trade, 4 or 27, rather than taking, I get 27 is a better swing trade, but rather than taking the swing trade, think about what ideal follow through would look like for you. So if you look at every swing trade on the day, you should be thinking to yourself, what would perfect follow through look like? That would make me think, had I sold this, I would be about to make a lot of money. And if you had sold below 27 and you see 28, what are you probably thinking to yourself? Oh boy, this trade could go a long way. I can make a lot of money. Well, why don't you, instead of selling 27, sometimes you end up losing, wait for something like 28 where you get that perfect, not perfect, but that ideal follow through, that you're mentally picturing. And then when you get it, you can just take the trade then, and you have a better probability of making money. 29, another bear bar closing near its low. So 3 straight bear bars, 27, 28, 29, and most of them closing near their lows. I'd imagine we're probably going to get at least one tick below 10. 90% chance we break out the 18 bar range. We're much closer to the lower, and we're in a bear channel making lower lows and lower highs. And bar 10 probably needs a second leg. As much as it is, a climactic bar, it does probably need a second leg, so we might have to get below it. 30, a doji bar, so disappointing. Probably buyers below, maybe somewhere, but not necessarily soon. And you got buyers below on 31, but you can see it didn't really do that much. So buyers below 31 around the bar 10 low, and the buy climax low 11 through 15. 32, a doji bar, probably sellers above. No one's buying above 32 and making money, and you get a big outside down bar 33, a bear bar. The tail on the top, yes, and a small tail on the bottom. Some bears sell below 33, expecting a second leg down. At this point, you can put a stop above 33, the lower high, so that makes sense. 34, follow through, a doji bar. 35, more follow through. You can see 34, 35, and 36 is follow through for the bears, but there's buying pressure. Excuse me. But there's buying pressure within the bars. So the large tails on 34, 35, and 36, maybe not necessarily as high probability to be short, but again, really tight channel down, we're going lower. This whole thing was forming a triangle. You could argue the measure moved down from the triangle, something like this. You could argue just bodies. You could argue for a measure move down of these, which is around the low of the day, because you could argue the triangle started up here. All those are fine. 30, 37, obviously a sell climax, right? We have a tight bear channel down, and then we get a climactic breakout below 37 low. But on some time frame, there's some bear that sold the low of 37, and they did a reasonable thing as it was falling. It wasn't great, but you know that in a 5-bar bear micro channel, that if you sell the low, you're probably going to make money. So as big as 38 is, you have to keep in mind the sell-off from 33 through 37 is going to need a second leg down. And that second leg is probably going to go below that bar 37 low. Think about it logically. If you're buying, would you ever buy above 37 and expect your stop to not get hit? No. So if you bought above 37, you would expect your stop to get hit. So that is probably why, or that's a reason that you could use to expect us to get back to that low. 38, a bull bar, but it's just bears taking profits. After that micro channel, we're going to get a second leg down. 39, disappointing. Probably buyers somewhere below, but not really that great. And then 40, a big bear bar. You can see towards the bottom of the range, and bears buyback shorts causing 41, a bull bar closing near its high. Consecutive bull bars, 41, 42. There's going to be buyers below 42 willing to scale in lower, but 41 is big bar, big risk. So as much as we might rally, I'm not sure how much higher we're really going to go. And outside, or the tight channel down also from 27 to 41. So you have to kind of limit your expectations when the move down is that strong. 43, an outside up bar, but a tail on the top and the bottom. High 1, 44, follow through, so consecutive bull bars closing reasonably near their highs. 45, another follow through bar, so 3 straight bars. 43, 44, 45. Again, probably going at least a little bit higher. 46, an outside down bar, an inside bar. 47, so an IOI pattern, possible final flag, a bear bar closing near its low. 48, if you sell below 48, I don't know. I mean, top of a bear channel, yes, but the whole move up from 41 through 45 is going to need a second leg. So it's a question of when does that second leg start? And we did end up getting the second leg, but it just ended up happening towards the low of bar 41. So the second leg was really delayed and did not happen until the bar 41 low. You also have to keep in mind 40 needs a second leg. So the second leg from 40 occurred during 54, and the second leg from 41 occurred during 55. If you notice, I've been talking a lot about second legs because evaluating strength, forget everything else. This is the bane of Brooks' trading course is that it's really complicated, and you're trying to learn how to paint from Picasso, essentially, is the way to put it. Al Brooks is the master of price action, and you're trying to read his book as a beginner and digest the whole thing. It's not really going to happen. If you think about it, if you wanted to learn how to paint, would you rather learn from Picasso or would you rather learn from somebody who's been painting for a year? You'd like to say Picasso, but the reality is you probably are going to learn more from somebody who's been painting for a year because they know they know how you feel, versus somebody who's mastered their craft has completely forgotten how it feels to start it. So my point in saying that is focus on, catching a first leg for a second leg and trading, basically that correlates with breakouts. So focus on breakouts that need a second leg is the way I should say it. Focus on trading breakouts that need a second leg in their context, and you will become successful much faster. 49, follow through for the Bears. Good for the Bears, probably going at least a little bit lower. 50, three straight bear bars, 48, 49, and 50. I would imagine we're going to get a second leg, but we probably still need a second leg up from the rally to 45. 51, sellers above 50 initially. 52, an inside, or not quite an inside bar. Triggers the low one short below 51, and then follow through 53, 54, but climactic. And if you're selling the close of 54, look where you're selling. Your risk is really big, and you're selling the bottom of a bull spike. So probably not really all that great. Instead, you get a huge bull bar 55. Bear bar closing near its low 56, but does 56 undo 55? No. However, the tight channel down from 48 to 54 means we're probably going to go a little more sideways to down at first rather than straight down, or sorry, sideways to up rather than straight up. 57, a bear bar closing near its low, 56, 57. If we get to the 54 high pretty quickly here, there should be buyers. Again, the reason why it's good to buy, if you're going to buy the 54 high, you have to do it over here, not over here, is because 55 still needs a second leg up. And as we're getting this pullback, there's probably buyers here for a second leg up. However, we get a wedge rally, 1, pullback, 2, pullback, 3, and then a sell-off. So after the wedge rally, there's not as much reason for the market to find buyers there. 60, a bull bar closing near its high. Some traders can buy the close. 61, a doji bar. Not great follow through, but some follow through. 62, another bull bar. The problem with 62 is you might be at the top of a trading range, but you have to expect us to go at least one tick above the bar 46 high for a second leg. And big, small, big bar 60, small bar 61, big bar 62. Just means we might pull back before we get there. 63, mostly a doji bar, so a little bit disappointing. 64, a bear bar, but really not a great sell after 5 straight bull closes. Then 65, a large bull bar. Bulls are trying to get a breakout above this bear channel. 65 ends up becoming a second leg or a third leg trap, if you want to say that. And then a bear bar closing near its low, 66. Bulls can exit below 66 or keep their stop below 64 and exit there. Either way, you didn't have, if you're a person, you didn't have much of a chance to move your stop. 67 collapsed pretty quickly and stopped traders out. Surprise, 67, 68, 69. That's the bear spike, and then you got to trade the bear channel. My trades today, I sold the close of 19, and I did not get stopped out here. So I held short for a measured move. So I got out of that here, but I ended up selling more on the close of 29. So I took partial profits here and took the rest off here. I bought the close of 62, taking a chance that we broke out above this high and got good follow through. Once I saw 65, I was trying to get a measured move, and I pulled my stop to 64. And I got stopped out down here for a small loss. And then I sold the close of 69 and held into close. I was trading SPY, so I had to get out somewhere in here. I got out of 70. It was a bear bar somewhere down here. So pretty much break even on that. And 2 trades where I made money today and a small loss on 1. For stop orders today, you could sell the close of 2 or 3. You could buy above 4, but it's low probability. I don't know if I'd buy this close. I'd probably wait. You could have sold these, but you know that this is going to get a second leg up, so it's a problem. You can sell 27, double top bear flag. This is the best trade of the day, 27, 28, 29. You could sell 33. I don't know if I'd buy above 41. You probably can, but it's just not ideal. You could maybe sell 48. I personally wouldn't. This is too strong for me. Maybe you can buy one of these closes or sell these closes. What is the best limit order trade on the day? I got to start doing this more often. Think about the best 1 to 2 limit order trades on the day. Probably, I don't know, maybe sell the close of 38. And if 39 is another bull bar, you get out. Maybe buy below 42 is a pretty easy one. Just kind of the upside can be limited, so the risk reward is kind of wonky there. Again, if you're going to trade on limit orders, you wait for a good bull move and you're buying on the limit order, expecting to catch a second leg. There should be a stop order pretty soon after it if you're doing it right. And yeah, that's really it for the daily chart. It's easy to look at this and say, bear bar, oh no, but reality is we might close this gap at this high, 59.27.25, but this is going to get a second leg up. So we're going to go back up to this price. We might pull back to here first, for sure, but there's going to be buyers in this area if we do. The weekly chart looks like we're going to get a disappointing bar. So tomorrow, the question becomes to the bulls, how big of a tail can they put on this bar? The bears get a big bear bar closing near its low. It's possible this is a bull trap, even if it does need a second leg up. So, this could be the exhaustive buy climax bar where it's 60% chance we get back to the low of the bar and 60% chance of one more leg sideways to up. So don't be surprised if we go a little higher before we reverse down, if we do reverse down. All right, that is going to be it for this review.